I'm like Capital here, back for another video. This is going to be another GameStop Reddit DD read aloud. Yet another post from Criand, the guy's name who made the post on Reddit. His name is Criand. The guy's a damn legend and the super stonk in the GameStop community. His DDs are all god tier in my opinion. So yeah, guys, let's just jump into it. Just a reminder, let's leave a like on the video, subscribe to the channel, leave your thoughts on this down in the comments below. Any questions or concerns or any requests, I will gladly do some read alouds if you guys have any requests for me. Other than that, just to let you guys know, I will be taking some water breaks in between. So if you hear a pause, that's what it is. I'll try to speak as clearly and concisely as I can, and let's just jump right in. So the title of this post, again, is from the username Criand, and it's titled, "The Fed is pinned into a corner from the 2008 can kick utilizing quantitative easing and the economic effects of COVID. They are stuck battling a collateral crisis and a liquidity crisis. The Fed is currently fudging the numbers of treasuries to hide a collateral shortage and to try to prop the economy up." So again, this is more of a it touches on, like every aspect of the economy. This does obviously it does involve GameStop. If you are an avid reader and you understand the DD, you know that the GameStop movement is bigger than just making money off the stock. It's become, almost like a financial revolution. People are finally waking up to the corruption that has been taking place, for God even knows how long, years now. And the government is likely complicit, with as long as the institutions that, are the SEC, the DTCC, FINRA. The whole point of it, guys, is everyone's involved, and this is a broader scope DD. So yeah, I'll start off here. So the preface: I am not a financial advisor. I do not provide financial advice. Da 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 da. I'm personally happy to see that there is a shift from GameStop DD to macroeconomics DD, which is sort of what I just touched on, because it provides a much wider insight into how the market is behaving and how GameStop would not be the cause of a market crash. Everything has been in a pressure cooker over the past decade, ready to burst, and the new DD provides insight on when things might go down. The new DD also diverges from the expectations of things to shoot up pricing every week, where everyone is watching the T21, T35 net capital cycles. It gives a general mother of all short squeezes will most likely occur when everything fails due to liquidation of defaulting banks, hedge funds, and financial institutions. It gives me peace of mind because I do not watch for specific dates around GameStop to cause the surge. I watch the economy at a macro scale to understand when things could blow. And to any skeptics, yes, it is possible that GameStop could never blow up. Do I think it will? Sure. But I encourage you to read this post disregarding GameStop and to understand what is going on in the economy on a macro scale. Even if the GameStop play is wrong in your eyes, it is good to understand how the economy could crash harder than it did in '08. I don't care if you don't believe in GameStop. I care about you, and I don't want you to be hurt. So that was just the preface there, guys. So part one, before we begin an overview of repo and reverse repo. So he's just basically going to explain, the repo and reverse repo that's been going on between the government and institutions in this country. Repo and reverse repo might be a bit confusing. You probably saw on this subreddit or in the news that the reverse repo market has been blowing up, and it is a bit concerning. It's not too complicated if you just imagine it between two entities, the Federal Reserve and banks. For both repo and reverse repo, it is an agreement between two parties for one of them to sell some security for a price, and they agree to buy that security back at a later date at a higher price based on some interest rates, usually. This is called a repurchase agreement, where repo is a standard repurchase agreement and the reverse repo is a reverse repurchase agreement, and the inverse of a repo. The length of these repurchase agreements can be various lengths, such as overnight, 1 month, 3 months, etc. But what we are seeing is short-term overnight reverse repos. The parties swap, and then the next trading day they swap back. It is not a permanent extraction of the underlying security. It is an overnight swap. A permanent extraction comes from quantitative easing or quantitative tightening, both of which I will discuss later. So a repo is a repurchase agreement. This is where the bank swaps collateral such as U.S. Treasuries for cash. This is used when the banks have too much collateral and not enough cash, or when the banks want to generate profit off of giving loans to other parties in the repo market. Reverse repo, reverse repurchase agreement. This is where the bank swaps cash, liquidity for collateral such as U.S. Treasuries. This is used when the banks have too much cash, liquidity, and not enough collateral. The main reason behind this behavior is to pump balance sheets for the night. Below is a diagram I made which makes this more clear. So it's just a diagram here, showing basically repo and reverse repo. The Fed gives money to the bank in the repo, and then the reverse repo they give it. It's basically just reversed. He just explained it, so I don't need to go over that as much. Part 2, quantitative easing, can kick of 2008, slowly draining collateral from the market. Note, if you want an overview of what led to the '08 crash, check out my previous posts. I believe this is the post about, it's another like macroeconomics post here. Yeah, the bigger short. Okay, so he references his last post, the bigger short, which I will do a video on as well, which has a summary of the documentary Inside Job from the year 2010. It also describes where we're probably headed based on SLR, the DTC, ICC, OCC, and CC rules, and mortgage default protections expiring June 30th, 2021. Zoom back in time to 2008. The economy took a massive dump due to Wall Street's abuse of derivatives and leverage. They created a bunch of toxic CDOs, mostly consisting of subprime mortgages, to create an economic apocalyptic scenario around mortgage-backed securities, MBSs. Everything was over-leveraged, and there was a massive balloon of bets based on the performance of the MBSs. Currently, there's evidence of Wall Street doing the same abuse of toxic CDOs, but this time with CMBS, or commercial mortgage-backed securities. The economy was hurting pretty bad from the '08 crash and was going to continue into a complete death spiral until the Fed introduced quantitative easing. The Fed announced quarter one in November 2005. Fed Chairman Ben Bernanke announced an aggressive attack on the financial crisis of '08. The Fed began buying $500 billion in mortgage-backed securities and $100 billion in other debt. Quantitative easing supported the housing market that the subprime mortgage crisis had devastated. If you're still scratching your head on what QE is, here's the Wikipedia definition as well as a more simplified definition. So quantitative easing is a monetary policy whereby a central bank purchases at scale government bonds or other financial assets in order to inject money into the economy to expand economic activity. This is what the Fed will do to extract collateral, including U.S. Treasuries, from the economy in order to push in liquidity. The Fed started this in '08 to extract toxic collateral from the market and encourage economic growth because it allowed more cash flow into the economy. This pulls out collateral from the economy and pushes liquidity in. It was a ticking time bomb ever since it started because it extracts collateral from the market, slowly creating a collateral shortage issue. So there's a graph below. It says check out the effects of quantitative easing on the Dow Jones. So it basically shows that it shows the chart, the yearly chart of the Dow, and it says it's in 2008 in November, Fed announces the start of QE, and then shortly after, the economy slowly starts to recover as toxic collateral and debt is sucked out. Can kicking of '08 begins. It was helping the economy reverse the death spiral and has been pumping the economy ever since the introduction of QE. The problem is, of course, that collateral would continue to be sucked out of the market through the mechanics of QE. And QE can't last forever, because collateral is a fundamental part of the repo market which allows cash to flow into the economy. When you don't have collateral, you can't post the collateral in the market for cash from banks, and thus the flow of cash basically shuts down. You cannot perform a normal repo transaction between a bank, hedge fund, and financial institution. The Fed tried to stop QE after a while. Instead of pulling collateral out of the economy, they needed to push collateral back into the economy. In order to stop QE, they tried what was, in essence, the reverse of QE called quantitative tightening, or QT. QT, or quantitative hardening, is a contractionary monetary policy applied by a central bank to decrease the amount of liquidity within the economy. This policy is the reverse of quantitative easing, aims to increase money supply in order to stimulate the economy. This is what the Fed will do to extract liquidity from the economy in order to push it in collateral. It is used to attempt to reverse the effects of QE to try to regain balance in the economy. This pulls out cash from the economy and pushes collateral in. The Fed attempted QT in 2018, but it proved to have very bad consequences on the economy, so they went back to QE in 2019, continuing the can kick effects of '08. This is a chart showing the Fed's total assets, where collateral is an asset for the Fed. So when collateral was extracted from the economy through quantitative easing, it went onto their assets side of their balance sheet. When collateral was pushed back into the economy through quantitative tightening, it was extracted from their asset side of their balance sheet. At the start of QE in 2008, there was a surge of assets due to buying up of MBSs and treasuries. 2. Around 2018, the assets began to decline because the Fed attempted QT by pushing collateral back into the economy and sucking liquidity out. Around September 2019, the assets began to increase again because the Fed went back to QE after realizing the negative effects it was having on the economy due to causing a liquidity shortage. So what happened in September of 2019? Why did QT fail after a decade of QE? So there's a graph here, which basically is another bi-yearly chart, and it shows, QE, the economy. It's tracking the economy basically. So in 2009, Fed starts QE, treasuries and other collateral are sucked out every month. And then it shows in 2018, 2019, Fed tries to reverse QE with QT. They realize it causes a negative effect on the market, so they go back to QE. And then the market starts stabilizing again. So part 3, quantitative easing cannot be reversed. The can kick continues until the economy crashes. Despite pumping in a bunch of liquidity into the market through QE, the economy was still lacking liquidity. When the Fed started to reverse QE through QT, the liquidity in the market tightened, and thus the negative effects on the economy began to surface in September of 2019. So there's a little graphic here. It says repo rate spike, a tale of low liquidity. Less than a year after starting QT, a liquidity crisis emerged on September 15, 2019, when the repo rate spiked up severely. This was a clash of events surrounding the lower liquidity issue. Banks' reporting dates are known inflection points in the short-term funding markets and typically fall at the end of the month, quarter, and of course the year. But periodically, the 15th of the month is also a pressure point. Such was the case this past Monday when a short-term funding rate that had been hovering around 2.21% soared as high as 10%. The funding market succumbed to a trifecta of pressures. 1. Payments on corporate taxes were due on 15th of September, leading to high redemptions of more than $35 billion in money market funds. 2. Cash balances increased by an additional $83 billion in the U.S. Treasury General Account, which reduces excess reserves and simultaneously acts to reduce the aggregate supply of overnight liquidity available in funding markets. 3. Dealers needed an additional $20 billion in funding to finance the settlement of recent scheduled U.S. Treasury issuance. On September 15th, as so many institutions needed funding, repo rates climbed well above the Fed funds upper end target at that time of 2.25% to briefly touch 5%. The following day, cash repo markets traded as high as 10% for those looking to finance agency mortgage positions overnight. Later that morning, the Federal Reserve Bank of New York acknowledged the pressures and conducted its first open market operation in more than a decade to add reserves to the funding markets that were clearly in need of liquidity. Subsequently, after its meeting Wednesday, the FOMC, or the Federal Open Market Committee, announced a cut in the interest on excess reserves of about 0.3%, 5 basis points more than its cut in the Fed funds rate, providing some relief to the upper bound of money market yields. Due to the reduced liquidity from QT, because it sucks out liquidity and pushes in collateral, the markets hit a critical point where there was too much cash that was needed and not enough to supply those who needed the cash. There was huge amounts of strain on the economy. This was most likely due to continued large leverage plus derivatives abuse stemming from what led to the 2000 to 2007 housing market bubble. The Fed realized that QT could not continue because of the liquidity shortage that was arising. They had to stop QT and continue QE in order to continue to pull out collateral and pump in liquidity, and thus the collateral shortage time bomb continued ticking. Below is a figure of when the repo rate shot up to 10% within a day. This was awful because it was much more expensive for loans to go out. The repo market would have shut down from nobody wanting to spend 10% on a repurchase agreement to get cash for the day. How would anyone get 10% return overnight to pay for those loans? The flow of cash was about to halt. So it's just a chart that shows that dip that I just explained. So part 4, COVID initiated a liquidity crisis in the banks, which now fight with the collateral shortage. QE continued until 2020 when suddenly COVID came in. Nobody expected it. And boy oh boy did COVID wreak havoc on the economy and the financial world. While the Fed was slowly approaching a collateral crisis through QE, COVID exacerbated the issue due to the sudden impact it had on liquidity. COVID increased liquidity, and when you have a sudden surge of liquidity, you need to balance it with collateral. The economic balance was tipping as of March of 2020. This does not take into account the effects of many people losing their jobs, being unable to pay rent, mortgages, and other issues that arose from COVID. Those all apply to another ticking time bomb, the CMBS issue, equivalent to the MBS bubble of 2000 to 2007, which I discussed in my other post. The COVID pandemic caused a surge of money being printed from stimulus packages in the US. When you print a bunch of money into the economy on a whim, you risk driving inflation of the currency itself. What does inflation encourage? Less spending from companies due to a higher price. This leads to less loaning of cash in the repo market and banks obtaining an ever surplus of cash. COVID caused a sudden surge of trillions of dollars worth that the economy couldn't handle naturally. Compare the treasury balance versus the deposits over time and the surge that occurred in 2020 in response to the pandemic. The COVID stimulus bills pumped into a massive amount of money into the economy at the risk of inflation, and we're already seeing the effects of inflation occur on the supply chain. So there's another chart here. It just shows how liquidity basically skyrocketed. COVID sends much more liquidity into the economy. Money dumps and inflation fears arise due to a sudden surge of funny money being printed. Stimulus checks were sent out to retail, companies were bailed out, unemployment increased, resulting in more unemployment benefits going out due to relief bills. More money printed, more money deposited at banks. There was a ton of cash being pumped into the economy over the past year from March 2020 to June 2021. Because of this, due to inflation and the excess of cash, banks began to get a surplus of cash deposited. People had more cash. They didn't need to spend money on rent, mortgages. Companies didn't want to spend more due to fears of inflation, so bank deposits went up. The main problem with this is that the cash deposited into the banks became a liability on their balance sheets. When you have a surplus of cash on your balance sheet, you need to balance it with assets such as U.S. Treasuries. The banks were now in trouble because they had way too many deposits. They were at risk of defaulting due to their own SLR requirements. Here is a figure showing how deposits of banks increased over time. It mushroomed during the COVID pandemic. So there's just a chart that shows the amount of deposits that had gone up. Much greater amount of deposits at banks due to the effects of COVID, less spending by retail, and the financial world. Banks' liabilities grew significantly. To combat this issue, the Fed decided to introduce a relief program for banks regarding SLR because of the massive increase of liquidity due to the uppercut that COVID created in the financial world. The Supplementary Leverage Ratio, or SLR, is the U.S. implementation of the Basel III Tier 1 leverage ratio, with which banks calculate the amount of common equity capital they must hold relative to their total leverage exposure. Large U.S. banks must hold 3%. Top-tier bank holding companies must also hold an extra 2% buffer for a total of 5%. The SLR, which does not distinguish between assets based on risk, is conceived as a backstop to risk-weighted capital requirements. In more of a simplified summary, SLR is a requirement of total equity that a bank must hold compared to their total leverage exposure. If they are exposed to leverage, they need to hold enough capital for that position, otherwise they are at risk of defaulting. In this case, they only need to hold a measly 3 to 5% dependent on how large of a bank they are. Just like in '08, these banks can have massive leverage, and SLR is supposed to help protect the economy from them abusing it. But hey, the Fed put in place some protections for the year to help those banks since they were obviously over leveraged to begin with. These protections expired on March 31st, 2021. The Fed is ending one of its pandemic relief programs this month. Here's how it will impact the banks. Just a little graphic. The Fed's relief program last year allowed banks to exclude U.S. Treasuries and central bank reserves from the SLR calculation. The relief program was a response to many non-banking institutions selling institutions selling treasuries to raise cash, and coincided with other measures, including the 2.2 trillion CARES Act, which resulted in even more treasuries being sold into the market. Right after the expiration of the protections plans for SLR, the reverse repo market began to blow up because the banks had way too much liquidity and not enough treasuries on their balance sheets. The argument that the banks were parking their money at the Fed was a reasonable explanation at first, though with 0% ROI from the RRP at the time, the banks would literally get no return on their investment. So for that argument, all of their other investments would have had to yield negative in order for RRP to be more enticing. Does this make sense to you that they'd use 0% RRP to be an investment? The fact that the RRP began to ramp up and then explode after the SLR protections lifted makes this look like a collateral shortage issue. And of course, with QE occurring over the past decade, makes it more likely, because collateral was sucked out of the economy and onto the Fed's balance sheet over the years. That, of course, was questionable on whether it was liquidity or a collateral issue, until the RRP rate dropped negative in March of 2021, as well as in April of 2021. Part 5, reverse repo rates flipped negative, warnings of collateral shortage. Think about it quite simply in a supply-demand factor. The reverse repo when the RRP rate dropped negative. You are a bank, you want to get collateral from the Fed to balance your sheets. The Fed says they'll give you a small amount of interest for borrowing their collateral overnight. But now imagine that the supply of collateral is too low and the demand is too high. The Fed will no longer want to pay you for borrowing the collateral, so it will shift the interest rate down. If demand really outweighs supply, then the Fed would want cash from you in order for you to borrow the collateral. So there's another graphic here from an article. The overnight repurchase rate, which measures the cost of borrowing short-term cash using treasuries or other debt securities as collateral, dropped to low as 0.06 in late March and hit that level again on Wednesday before stabilizing to 0.01 on Friday. This was just one of the warning signs that the collateral issue was rising. The RRP rates were already at 0%, so the only way for them to move was either up or down. An increase in treasury demand could shift it down into the negatives, which it did. Part 6, the Fed is fudging the numbers and hiding a collateral shortage. The drop in RRP interest rates to the negative came after the Fed increased the total borrowing amount of counterparties in the RRP from 30 billion to 80 billion. So another screenshot here, it's from another article. Fed increases RRP limits from 30 billion to 80 billion to ensure supply at near zero rates. Why did they do this? Think of it again as a supply versus demand issue. For simple math, imagine the Fed has 50 members. At a limit of 30 billion per member, that is a total of 30 billion times 50, which is 1.5 trillion that can be borrowed. At a limit of 80 billion per member, that's a total of 80 billion times 50, 4 trillion that can be borrowed. What is this doing? Why did the Fed increase its limit? It's artificially inflating the total supply of treasuries that can be borrowed by counterparties in the RRP. It is attempting to keep the interest rate positive because there is so much demand for collateral and not enough supply in the markets and on the Fed's balance sheet. The RRP was already at 0%. There was nowhere for it to go besides negative, which as you know implies a shortage of collateral and a red flag in the financial world. Not only did they artificially inflate the total supply to combat the demand by increasing the total borrow amount, the Fed decided to not affect the assets side of its balance sheet during these RRP transactions. This effectively leaves the supply of treasuries on the Fed's balance sheet the same. This is another method to can kick to avoid interest rates going negative and flashing a collateral issue. When the desk conducts RRP open market operations, it sells securities held in the System Open Market Account, or SOMA, to eligible RRP counterparties, with an agreement to buy the assets back on the RRP's specified maturity date. This leaves the SOMA portfolio the same size, as securities sold temporarily under repurchase agreements continue to be shown as assets held by the SOMA in accordance with generally accepting accounting principles. But the transaction shifts some of the liabilities on the Fed's balance sheet from deposits held by depository institutions, also known as bank reserves, to reverse repos while the trade is outstanding. We can see this visually from the Fed's balance sheet that they are not affecting their assets during the RRP. They're allowing counterparties to borrow treasuries without affecting the supply, desperately trying to get away from the rising demand for treasuries and avoid treasury yields from snapping down, and likewise the price of treasuries up. So there's a graphic here. It shows the Fed's balance sheet. RRP starts to explode, but the Fed is not affecting the asset side of their balance sheet. It's as if the treasuries borrowed overnight never leave. The Fed also increased the total borrowing supply from 30 to 80. So it just shows the increase over the past year in millions of dollars. On top of this, the Fed showed their hand once again of fudging the numbers on June 16th when they bumped up the RRP rate to 0.05. The short-term treasury yields briefly went below the RRP interest amount of 0.05% on June 17th when the new RRP ROI was in effect. This is a bad sign because the now overnight RRP had a higher return than the 2-month and 3-month treasury bonds. The Fed is fudging the numbers trying to hide the treasury bond shortage. The Fed cannot keep this up. They're trying to tell the T-bill yield curve trying to keep the T-bill yield curve propped up despite the treasury shortage. They're not affecting their balance sheet, and they also artificially increase the amount of treasuries in their supply by increasing the counterparty rate from 30 billion to 80 billion. So there's a chart here that shows the UST yield curve, how it's starting to decrease, and then how the short-term yield percentage dropped. So the Fed is also planning on increasing interest rates. This starts to scare the economy, which is most likely why we're seeing the dump of the stock market over the past few days and the dump leading into the weeks of June 21st. This is bad for the markets because it means it's going to cost more for the economy to function. Exactly what happened in 2019 when repo rates spiked to 10%. Companies have to spend more to hire, produce, etc. It costs the economy more to function. The Fed is pinned between a collateral issue from QE sucking out collateral and the liquidity issue from COVID pumping in too much liquidity for the banks to handle. So there's a screen grab here. It says the Fed moves up its timeline for rate hikes as inflation rises. U.S. inflation sees highest level since '08. Part 7 here. Quarter ends explode the reverse repo. The next quarter end is June 30th, 2021. This is not a date to look forward to for GameStop potentially rising. This is the date of holy shit. The RRP could explode to the point where treasury supply versus demand is unable to take it anymore. About 3 to 4 days prior to quarter ends, the RRP explodes up in the amount of collateral that is borrowed from the Fed. This is because of underlying plumbing in the financial markets identified in Section 3 above, causes additional strain on the financial markets. The banks need more collateral to prop up their balance sheet for the night of the quarter ends. The RRP borrowed amount can shoot up almost 2 to 4 times the current levels. The amount of RRP at the moment is 747 billion. The RRP could explode 2 to 4 times the amount it is upon June 25th, 2021. What if it's 1 trillion by then due to the massive amount of collateral needed by banks? More? Can the Fed handle it? Can they still prop up the yield curve? Will the short-term treasuries dip below the RRP amount once more due to the shortage and flash red flags to the world of financial stability in the U.S.? So there's another graphic here. It says reverse repo rates spiked up because fiscal quarters are ending. They need collateral to pump their balance sheets for the night. This happens consistently every single quarter end, going all the way back to when RRPs started around 2013. There was a sudden surge of RRP within 2 to 3 days at the end of a quarter. So it just shows a bunch of graphs of the RRP rates going up. If the U.S. Treasury yield curve snaps down from this instability and the Fed no longer is able to prop up the yield curve, then it can drive Treasury prices up. If Adabit's everything short is true and they're actually shorting Treasuries, then that can lead to banks defaulting due to the price of Treasuries shooting up. When they default, they'll be forced to buy up all the Treasuries that they've shorted into the market, and it is very possible that they are shorting Treasuries. When performing RRP of 0%, the repo market was most likely shut down due to nobody needing cash loaned out. The bank's only profitable move was to perform the RRP with the Fed and then short treasuries into the market, rehypothecating the treasuries to other parties. This would have also helped prop up the market by artificially increasing the supply of treasuries in the market. If it's true and they have been performing the everything short, then it could initiate a global financial crisis equivalent to the Great Depression. Do I want that to happen? No. But is there a chance? Yes, there is. Is GameStop going to squeeze? Is the DD just false hopium? I don't think it's hopium. I believe in the DD. But some users might think otherwise and do not believe in GameStop or the DD. Hello, users outside of Superstonk. If you're reading this, check out the DD on this subreddit. Even if there's a slight chance of a GameStop squeeze in your eyes, and all of these signs are pointing to a market crash, why not give it a shot? So I do just want to read his top comment here. It says, "Ah shit, here we go again." Also note for repo and reverse repo that it is not just between banks and the Fed. The repo can be between hedge funds and financial institutions and the banks, where they swap collateral for cash. I only provided the Fed and bank transaction example for the context of this post. Yeah, guys. So I just thought this is really interesting. It's a little bit different than a normal GameStop DD. You know what I mean? Um, if you've been following the situation and if you're paying attention to the financial markets right now, you should probably know that a storm is coming. A storm is brewing. The financial markets have not been in great shape, especially due to COVID, due to '08, due to everything explained in this DD and in other posts that I've read. That's just my personal take on it. I do see a major correction. We're already seeing it in crypto. You know what I mean? Crypto has been, losing its footing really, really hard lately, and the fundamentals haven't changed. I'm also big in crypto, which I'm sure of you noticed. Due to my other videos. But yeah, guys, please leave your thoughts on this down in the comments below. Like the video, leave a subscribe on the channel. We could definitely use the support to get this information out there. And just like Criand, he said that this post is, to help people, to warn people that things are getting very critical. And that is the reason that I make these videos, is just to relay this information out to somebody. I hope this information reaches, a fellow ape, because that's all I am. I'm just a GameStop ape, you know what I mean? Trying to make my attendees, as cliche as that sounds. But, I do believe that some dark days are ahead of us, and hopefully, GameStop will be a hedge against the market crash, which is, it's been indicated in the past. So, yeah, guys, I hope you enjoyed the video. I hope this helps somebody out. Please leave support on the video. And I'll have a couple more of these coming pretty soon. I will do another one of his posts, his post right before this. I will have this up by the end of the week. So, yeah, guys, thanks for the support. Hope you enjoyed. And again, I'll catch you in the next one. Enjoy the rest of your day. Thanks.